But I think the meme that was nothing ever happens has turned into everything is happening all at once, all of the time.
Nothing said on One Shot is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Michael, Vance, and our guests may hold positions in the companies, funds, or projects discussed.
What's up?
And we're back.
We're back. Welcome back to One Shot, the biweekly podcast that has turned into a weekly podcast because there's
We're gonna hold ourselves to the standard of weekly, biweekly. We will have things to report on as they happen. We will have subjects
we'll
as
break
they become
news.
interesting. We will have guests as they have relevant things to talk about and updates themselves. We're gonna be free form and not
Documentary filmmaking. There's no bounds to this podcast. But I think the meme that was nothing ever happens has turned into everything is happening all at once, all of the time, especially with the geopolitical conflicts going on. I don't think we are going to espouse any personal views on like if this is a good or bad thing. I think it is what it is, and we'll play the hand that we're dealt. But it is quite the week in macro oil that was literally everyone remembers when it spiked to 120 during the Ukraine war, and I actually got that wrong, Michael. It was like basically right as it happened, first like 3 months, um, that spike, and it went to 50. As of like a month ago, or I guess 2 weeks ago, and now it's back at 100. It seems like it's max political, violence on both sides. It's the strait is being mined, or maybe not, depending on which news report you get. Um, but there's a lot going on.
Yep, we're at 96.5 as of
Are
Thursday at noon.
are you checking on Hyperliquid or what are you checking on?
WTI crude spot on I don't know who, yeah, just the spot market on trading view. But it is it's interesting. I think the big question now is sort of like what happens in the strait. Seeing photos of people posts from Dubai at night of just like the tankers that are lined up. Also seeing all kinds of fake news and fake videos of like things catching on fire and things getting bombed out. It's just like, no, these thank God you have Grok on X to just,
That's true.
tell us whether or not this is a real thing. Don't need to go too deep on what happened on Sunday night, what happened on Monday. It's now Thursday. Things seem to have quelled a bit, but the spike from like 80 to 120 back down to 80 or 90 was a violent move. Um, and it seems like what has been notable, especially as it relates to what we usually talk about, is a lot of this was happening on Hyperliquid. And a lot of it, I think, when you have these liquid markets for non crypto assets built on a crypto platform that trades 24/7, with perpetuals, there's just a lot of room for this stuff to move wildly. And one of the things that we've talked about internally is just like what happens if we're moving to a world that has much more volatile markets, where it is not uncommon to see large cap companies plus or minus 10 to 20 to 30%, hundreds of billions of dollars, $1 trillion companies move on that type of news. And we're in the middle of a regime change, I'd say, in terms of the stock market. But now you're starting to see things like oil or commodities move in those directions, which is it is very uncommon for that type of stuff to happen. Yes, it's Ukraine war. Yes, it's Iran war type events. But I generally think, especially as we have many different new trading venues that are 24/7, you're going to start to see more volatile and interesting ways to play different markets that will lead to more activity. But yeah, one of the big winners here, I think, out of all of this is hype. And you're starting to see it now hit all-time highs in terms of BTC, ETH, and Sol. So that ratio is now at all-time highs. I think that the token itself is somewhere around the 36, 37. But it just seems to be that, hip three with these different markets and some of the off non-crypto assets are really exciting. And it's positive to see from a crypto perspective. Now, obviously, the whole war and everything, who knows kind of where this leads. I've heard so many different takes. It's now probably not incumbent upon us to give our perspective or regurgitation of any of those takes. It just is what it is right now. But I will say, I think just given the nature of where we are in a midterm year in the political sphere, this stuff probably ends or at least gets declared ended sooner rather than later because there's just a political gravitational force to stop this, soon. And now you've got, I can't remember how many barrels, but it's a ton of barrels out of the SPR that are getting unloaded to keep oil prices down, or at least attempt to keep oil prices down. There's now 8 states where diesel is over $5, and I think California has over six. Um, so you're starting to see these effects, affect the pump or affect the prices at the pump, which will have direct effect on downstream. This is what happened last time. This is why everybody's freaking out. It's like um, you have people who are scared that high oil or energy prices lead to future inflation, which is what happened last time a couple years ago. Um, and so, yeah, I think that is kind of where people are now like in this um, risk off perspective. So that's kind of my read of the market. Exciting stuff for crypto, unsure on everything else, but taking it day by day, week by week.
Yep. Yeah, I saw. I mean, it's possible that if oil goes to like 150, we see double digit prices at the pumps, $10 a gallon, which would, I don't know. I was filling up my car last night. I don't know where another number would go on that board. Like they may have to like literally tape a one to the side of it or something. The good news this time around is that the fracking in the U.S. has really meant that the U.S. is now a net exporter of a lot of energy. Um, there does seem to be some sort of resilience built up with these stockpiles and the ability to release them. But if this goes longer than 20, 30 days, like that release is null and void. So we will see. But I think generally speaking, what you're seeing in crypto markets is things that have connections to real world assets. HIP3 is an example of that, do really well. Sky is at all time highs for supply of USDS. Um, so there are some safe havens. And then the stock market seems to be, I mean, the indices are still pretty much at the all time highs. Maybe that's changed today, but um, under the surface, there's just a ton of regime change. The software companies are down. I was looking at an insurtech provider today. They're down 60%, not for any really good reason, just because AI is kind of coming for all of them. And then, you have these AI companies, which are private, which kind of exist like off screen. You can't see any of their financials. You don't get any updates except for like when they forecast ARR. And um, those are going public apparently. And maybe we talk about the IPOs, and I think the first one is in June. Allegedly, SpaceX is going to go public in June at 1.75 trillion and raise 50 billion. Like that will be a huge test of this market. And I was just looking at, I was asking ChatGPT last night, like what were the IPOs in 2001? Right around the start of the first Iraq War, and there weren't many, right? Like, and that was probably like an order of magnitude more chaos, or maybe 50%. But these things, uh, these things, ripple across all capital markets, both private and public.
I'm not sure if that's necessarily like a fair comp per se. Just the Iraq War. I think what was going on in 2001 was the bottom of the Nasdaq, right? And 2000 being the end of that. But I will say, I think the to your point, the bigger question here is, can you have a $1.7 trillion IPO followed by a $1 trillion IPO, followed by a $500 billion IPO, followed by it's just like where does the capital get sourced from? That I think is the bigger kind of structural question. And I still think that there's gonna be a lot of people who are like, oh, this is the single asset that I own to have like exposure to Elon Musk. And that I think is a very positive pitch, especially if you can pair things like XAI, SpaceX, and potentially, well, obviously Twitter as well, but who knows what's going to happen with Tesla? I mean, it would be a really interesting reverse takeover, private public transaction. But I think, yeah, the bigger point, at least from what you just said, I think is like the quantum of capital required, is still a TBD for what happened this year.
Yep, and, there's the alternative that these companies stay public, or sorry, stay private for longer. Um, the Middle East and all of the member countries, are huge financiers of private companies, and I've seen a couple of reports about, maybe they're gonna be pulling back, maybe they're gonna be doubling down. But I think for the time being, while the oil is not flowing, they're probably on pause. And so, like, that capital is really smart, it's really agile, it's fast, but I think that's just slowed down by all of this as well. And so I think they're in a position where some of these companies probably need to go public. I don't think SpaceX is in that camp. I think they're profitable, so they can kind of maybe, if it doesn't look good, they pull last minute. Um, OpenAI has 110. Anthropic has 30. I guess they raised, so they have time. But I think a base case is that a lot of these private companies are going to be public in 2027, and there's a lot of them now, and they're all worth like 5-10 billion. There's the neo labs, there's the robotics neo labs, there's the like even Replit yesterday raised 400 million at 9 billion, and that was led by a Canadian venture capital firm I'd never heard of. Like it's starting to get more dispersed, um, which if you remember kind of the buildup of all the private tokens that were supposed to launch at these super high valuations, it kind of reminds me of that a little bit. There's more fundamentals in these businesses, obviously.
Well, yeah. So look, I don't know if this is a full subject change, but I think that it's worth talking about what I would broadly dub like the, the bubble forming in private VC land, um, which feels like every week. It feels like we're hitting a new kind of all time high for that spidey sense tingling a little bit. But then it just gets surpassed by the next week and hitting a new all time high for even more tingling feeling. Yeah, this week it's you've got basically every company that has a native AI business model or product that is hitting tens of millions of ARR and growing rapidly has a multi-billion-dollar valuation. Historically, this multi-billion-dollar valuation would be something that is required once you hit probably like 50, 75, 100 million of ARR. And what is different and what is fair to call out is that the growth rates are materially different than what you saw with enterprise SaaS, and they're hitting these numbers not in years, but in potentially quarters and sometimes months. And so that I think is where you get, extrapolation comes into play, and you can start to say, okay, well, if we're hitting, 0 to 20 in 6 months and then 20 to 75 in 3 months, we can say that we'll be hitting 500 to a billion if we assume that these markets for AI dominated services are as big as a lot of people think that they are. But you're going to start to see these private public dislodging mismatches where you've got the publicly traded entity which is getting beaten down. Look at Figma; it's down 80% from the IPO, or I don't know where it is today, but broadly speaking, it's now like 80% down from its IPO, uh, or peak. Um, and then it's also got private market, companies that are performing at higher valuations. It's just that they don't trade in public markets, so they don't have the same effect. If they were public, it'd be a different story. And I think this comes down to sort of the incentive model, and it's worth calling out. We've talked about it, you know, multiple times over the last few years, but just to call this out, when you are a venture firm, there's two things that you get typically, and it's usually a management fee and some sort of performance fee. The management fee for a 10-year fund, or potentially even longer, is typically 2%. In some cases, it'll be 2% over a period of time and then a step down to like 1% over the next period of time. But you're getting paid basically to manage this capital. But what that really means is that you're getting paid to deploy that capital, and then you're getting paid another fund in 2 to 3 years to raise that and then deploy that as well. And in many cases, like I have seen a few even early stage funds that are in this cycle, deploying capital probably in like a year's time, or less. Um, and they're actively looking to raise their next fund because they've already passed that 70% deployment threshold. And I think in many of these other cases, it's just a dislodge, or it's just it's a miss on incentive alignment.
Let me give like a Figma bull case. and then talk through maybe some of what I think is happening. So Figma, just to put numbers to what you were saying, they do about 4 billion a year. They're growing 45% per year in revenue. Uh, the gross margins are pretty good. I think they're like 40%, 50%. And I think the business is actually pretty levered to the AI, like what the AI promises. In my mind, the promise of AI is not making the 10x engineer and a 1000x engineer. Maybe that's part of it. But I think the broader market for this is like making people who can't code able to build websites, able to build applications. Um, and so when you see something like Replit worth 9 billion, and then you see something worth like, and there's, he went on a podcast on TBPN and said he didn't track ARR as a metric. It's not a useful metric. Obviously, the public markets don't feel that way. But with Figma, it's only worth 15, 16, 17, and they have 4x as much revenue, allegedly, as Replit, even if they're at a billion. So there's some sort of mismatch happening here. And I think, your point earlier was like people just think these markets are 10 times, 100 times larger than we can expect. I think that certainly could be possible. I think the other thing that could be happening is just kind of like some of the cardinal sins of last cycle and even this cycle with crypto has been the extrapolation at the top to the rest of the year, the decade, what have you. Um, if you think about people with using Claude Code or even the Mac Mini crew, there's a lot of upfront spend because it can feel very productive to start a business. But then those people churn. If most of the revenue or some of the revenue of these things is, from these startups that have 6 months of runway left, or the investors that are investing into these companies are forecasting the revenue based on those startups, like that's where you really get into trouble. And these companies are probably, Anthropic and I would say maybe OpenAI are worth more than they are today in the fullness of time. But I think there's this question that's starting to arise around like what is ARR? Like how do you define revenue quality?
Here's what I'll say, and this is probably the best comp to Figma. And if you got the Figma numbers, I've got the Lovable numbers. But Lovable, which is actually a Swedish company, is basically Figma but AI native in a lot of senses. It's sort of like speak whatever you want built, and then it'll make it for you. Whereas Figma is sort of a design tool, maybe like it's more of a competitor to like the Photoshop Adobe Creative Suite, um, which is more web based, and that's where it started, and just made it easier and more accessible than these kind of like heavy tools like Creative Suite. And so I think there is an element of, can Dylan and Figma, go AI native after they've already built this user base, this customer base, this product, and then convert it into something that is AI equipped or AI native? Or is it going to be something new like Lovable, which is starting from an AI native perspective, but having the same outcome? Like my sister in law was talking about how she's organizing a bridesmaid or um, bachelorette. And she just went into Lovable and like made, little posters and little invites and little thing. And it's like the stuff that would be kind of like hard to do or just like take you an afternoon on a Sunday to build is just like a prompt. And that is it. And it's just like Lovable and you're done. And I know all kinds of people who are like making websites with it. And like it's just, you've got all different types of creative outlet or creative product outlet uh capabilities that Lovable is excited, and is definitely growing quite a bit. And so that I think is the comp, which is they just raised at a $6.6 billion valuation not too long ago. What they said yesterday is that in the last month they went from 300 million ARR to 400 million. So it's growing 30% month over month, whereas Figma is growing 45% year over year. Obviously, it's at a much higher base, but the CEO is saying, well, we're at 400 million ARR right now. We are forecasting to have a billion in ARR by the end of this year. And so that growth rate is where people are just like, it's a feeding frenzy in the private markets. And that is, I think, the comp where, let's say they raised at a 300 million ARR, 6.6 billion valuation. It's a pretty healthy 20x multiple on that. Whereas Figma is what, a 4 billion ARR at what valuation? Like 15?
15 today. Yeah.
So a 3x. And that's the difference right there. And you can justify some of that difference, I think, when you're looking at growth rates. And it's basically like I don't even know what the IRR of that growth rate would be on an annualized basis, but when you're growing 35% month over month versus 45% year over year, That is a very, very large difference. It's just whether or not you can keep that up, to your point on like um, multiplying the average daily revenue by 365 is never going to be a fair way of doing it.
No, and I guess the question for like, your sister-in-law is like, how many more websites is she going to create this year? Is she going to keep that subscription? Is it going to be something that's enduring? And I think one of the things about the private markets, which is, not only do you have I mean, there's some sort of premium or discount around illiquidity. I guess it's a premium today. But over the life cycle of these companies in the private markets, they do take on more dilution, and there is stock based comp in the public markets as well, but it's generally lower than like another 10% round, another 20% round. You're just eating that, and so I think those two concepts, at least in my mind, should at least theoretically imply that the public markets have a premium to the private markets. Is not what's happening right now. Um, and then the other thing that I would say is you know, having a stock that's fully unlocked. So Figma, I think, went public last summer and then fully unlocked everyone. So like in public equities land, they do the unlock it, I think 6 months or the second earnings date. And so everyone can sell, everyone is free to sell. I think Figma had a really, really, really good cap table of like people like Sequoia who actually bought more in the open market. First time I've ever seen them do that. But these private companies, as they go public, they will have to unlock. And like even something like CoreWeave is still dealing with Magnetar selling on a daily basis. So there's no free lunch in terms of like who you share the cap table with on these private companies or the dilution that you have to take on to get it public.
Well, yeah, and so I think maybe like distilling this whole thing down, let's say there's a 3x revenue multiple for public markets right now.
Yep.
And it's not a fair comp because obviously they've got bigger bases, growth rate, all of that. But then it's a 20x multiple on the private markets for generally, I would say like a similar product category, but different approach, which is like an AI native versus a software native approach. And I think that there's also going to be a question as to, and this is a conversation that we have with portfolio founders. There's a question as to go forward organizational debt or cost structure that is imbued within this. And I don't even know how many employees, but I know it's thousands of employees are at Figma. And I know that there's probably tens of employees at Lovable. If you have an AI native organization that is able to build these tools and have the go to market distribution, all of the support that starts to get automated. You're also able to say not just from a top line perspective, your growth rate is a different comp, but your bottom line is also going to be a different comp because if you're AI native as an organization, not just as a product, you're going to have an advantage there as well. And so I think there's a lot of things that are just making people more excited about like this transition. And so it comes down to the fundamental question: is this transition as big as we think it is? As well as is this transition going to enable new products in the same categories? So we know that the market is there, but a new product that is differentiated versus like something that previously existed or previously, is the next generational shift. And sister-in-law is not, it's not really a question as to like how many more bachelorettes is she planning this year. It's more a question of like, did
Better be once a month if they're counting it as ARR.
well, right, fair. But the bigger question is she didn't have a Figma subscription beforehand, and she definitely didn't have a Creative Suite subscription beforehand, but now she's using Lovable. And so are there more places where you would be able to plug in because this product is an easier user experience or easier onboarding experience? So a lot of really big questions. I mean, these are like this is why things are kind of in like a wait and see, hold, risk off perspective right now, where the SaaS sell off was the last couple of weeks, couple of months. Now it's sort of like a I don't know. We'll see kind of how these things play out. But I do think one of the interesting comps here as a maybe potential transition is thinking about public versus private. And this week we actually saw for I think one of the first times, at least, notable first times across protocol, which has a publicly traded token, decided that they were going to take their token and take it private. And no, it was not done at 420 a token, but it should have been.
Could have been.
And I think it should be notable in that they not only said we're going to take it private basically at a step up price from where it was trading over a 30-day TWAP, but and it obviously it traded up to that price basically immediately, but it also surpassed that price by about 40%. And it is a pretty substantial premium to where they said the take private price was, which probably suggests that some of these assets in both crypto but also public equities land are just beaten down so hard right now that you'd rather have a private asset. And I think that there's a lot that we can glean from that. Um, but there's some really interesting takeaways, which is you don't have the structured selling on a given basis, and there's a lot of people, especially in crypto, that are just down so bad that they're just like every single day they get liquidity, they're just selling a little bit because they need to. And so maybe in the private markets that improves and you can stop that. But number two, it's when you don't have to be beholden to public token holders or public shareholders every single day, every single month or quarter, you're able to do things like we're talking about from an organizational perspective that allow you to kind of become an AI native, company. And maybe that means like going through a restructuring of the organization. So there, I find this to be an interesting kind of comp to what's going on in crypto land as well. And the reason why I say this is I don't think that Cross is going to be the only one to do this. I think there's going to be a lot of others.
Yeah, I think we've been spending most of our time and frankly most of our capital in the public markets probably for a long, a year now. Um, Still doing the Series A's and the seeds that we think are interesting, but it's slower. The prices are higher. There's generally a lot more competition for those types of things, and there's no doubt everyone feels amazing about their privately held tech company shares, defense shares, what have you. And the mark to market volatility is not just like a feature or a bug of the asset. I think it is something that freaks people out that are running these companies because they're like, wait, I have to check my stock price every day. Um, Eventually, there is no free lunch. You do have to go public or get bought, and maybe getting bought is kind of more of where these AI companies end up. But I think there's a ton of value in the public markets, and we're excited about a lot of stuff. And people probably saw the better announcement this week. We don't have a ton to say on that, and there's more forthcoming, but there's a lot of value out there, and it's exciting. Um, I do think on the crypto side, the stuff that we've been paying attention to is, I mean, Sailor seems to have discovered something, and STRC, which is the product that MicroStrategy issues, that is a perpetual preferred equity instrument. It pays 11.5%. It isn't debt, so you are on the equity side of the cap table here. But they found a lot of interest for this, and they're selling. I think what did they sell yesterday? Like 184 million, 200 million of this.
Right. So maybe, uh,
Give the site.
yeah, well, it's strc.live, is the website. Um, and we're kind of doing a deep dive into this itself right now to see how they're getting this data or if this data is accurate. So like TBD, we could be promoting something that has like
Be a lovable bachelorette party invite.
not accurate ATM sales data, and it's independent, so it can't be affiliated with strategy or the product itself. But the basics are, and so to talk about this product, the basics are it's a preferred share, and so you are on the equity side, but you're also ahead of common, and there is some. I would say if you believe that the price of Bitcoin stays above some threshold, and by some threshold I mean like $10,000 um, for a long period of time, then you're going to be basically backstopped by Bitcoin. And what they're making a bet on is that this 11.5% is lower than the average return that you would get over the period of time that you're holding this asset than what Bitcoin performance will be over that same period of time. And so they say, okay, if the average growth rate per year of Bitcoin is 30%, or they forecast that out going forward, it's 30%. If we're selling basically cash at 11.5%, like that's an accretive transaction to us because we're going to take the cash that we raise from this product and put it directly into Bitcoin, which is going to earn us 30% plus. And so if you trust in Bitcoin, if you trust in their ability to continue to raise, there are some other features where um, they have the cash on the balance sheet for 2.5 years worth of payments. And so part of the balance here is like over the next 2.5 years, even if they had zero sales, you're still going to receive those cash payments. Um, it's also um, it trades on the Nasdaq, and basically par is $99.99. And if it trades above, they can sell ATM. If it trades below, it it definitely they don't do ATM. But if it goes below $99, and it has traded in the mid 90s earlier this year when it was still getting launched, I'd say now it's kind of like hitting its real launch. After they had their meeting in Vegas earlier this week or last week. But all of this is to say that the yield will go up if there are prices that hit below certain thresholds. They also have the ability to reduce the yield if it's above certain thresholds. So, like, let's say Fed funds rate gets reduced, they can reduce it the same amount as the Fed funds rate on that month. But they can also only reduce it 0.25% per month, whereas they can increase it more than they can reduce it. And so you're at least protected from, like, over the next X number of months, it's going to be in some general frame. And it's a it's a highly liquid asset. If you wanted to sell the assets itself, you could absolutely do that. The other thing I would say is, for US investors, and this is a structure that is common in REIT type products, or property type products, where the distributions are not actually considered interest payments, which would be taxed at ordinary income. They're actually considered deferred return on capital. And so what this means is that when you have 11.5% yield, instead of having to pay taxes on that 11.5%, you don't actually pay any taxes. You defer those taxes until you sell the underlying. And so let's say you have an 11.5% gain. You can effectively capitalize the yield on that asset until you sell the shares. And so it would be like you bought it for 100. Let's say you earned 10%. That means that it would basically be like you selling the asset for 90 and then realizing the gain on sale, which is a capital gain on the underlying asset itself, as opposed to the 10% that you earned over the hold period. So what this means actually is that you could have long-term capital gains, but also even if you had short-term capital gains, those can net against capital losses, whereas ordinary income or interest payments cannot. And so this becomes a pretty advantaged product that is post-tax 11.5%, which you can assume, like BREIT is another product that has, and they have their own issues, but it's a REIT product that's pretty popular, where it targets a 5% cash on cash return, but it has the same return on capital components which defer the tax, and so it promotes itself as being a like 7.5 or 8% yield pre-tax product, whereas it's really 5% post-tax. So this is like I'm starting to see where Saylor is talking about with his, like, this is the iPhone moment. And just as context, um,
No, you didn't build anything, Sailor.
well, right, they're selling financial products, but this financial product is pretty attractive. Um, and I don't own any, we don't own any. Like, this is something that we're just kind of discovering today, so we're talking about it. But just as context, at least if this data is accurate, strc.live is the website to track this, and it's super interesting because it's real time. But it assumes that they have accumulated 4,000, almost 4,000 BTC today. Yesterday they did 2,000. And so if they're yielding, let's say 1 to 2 to maybe 3,000 on average, 2,000 per trading day, that means that in 50 days they will hit 100,000, 50 trading days. So that's 10 weeks. That means that you get basically 100,000, 0.5% of Bitcoin every 10 weeks at current prices. So this is like a fundamental unlock. And I feel like people are just now kind of starting to get their head around what this product is, how it works. You're starting to see the dividends for people who hold it. And you're also starting to see these announcements of these companies adding it to their treasury balance sheet. So, like, Anchorage said that they're going to buy some and hold it on their treasury balance sheet. I think there's a number of DATs that have said this as well, like Strive. And so this is just becoming kind of like, why would you want to hold your assets in money markets? And yes, there's the risk reward, and yes, like this
Why
stuff.
hold it in T-bills when you give it to Sailor? No, I look, I agree with you. I also do think that even if Bitcoin went down to even like 10K, he would still be money good on this for a number of years, and they'd have to restructure it. But like, kudos to him. It's not an iPhone, but he's developed something that allows him to buy a lot of Bitcoin. And maybe, maybe they're sowing the seeds of a recovery here for BTC.
Well, and so this is going to be my next point too. It's like we're starting to see what we are looking for broadly as an industry. Like, are we've been asking this internally? Like, what's the positive narrative that pulls things out? Um, and I think, not to get too ahead of ourselves, but to stay on the subject, I think that there's a couple of potential things that are really interesting right now in crypto. But my guess is that, of the categories that can build a new narrative that pull us out, there's basically three options. And this is probably in order of like most likely to, or least likely to most likely. Something in the crypto AI space that just takes off, and this is some sort of product. Either it's a decentralized, model running network, or it's a decentralized compute network, or it's something that has to do with the true intersection of crypto and AI, that launches and kind of builds itself as a really interesting new category, and kind of establishes crypto as fundamentally connected to the AI space, which is already booming. The second category I'd say broadly is on-chain capital markets, which it's DeFi, but it's lending. It's you're starting to see, like we said, all-time highs for Sky, TVL. You start to see a lot more capital move in, from the stable coins. There was a great chart, which is like if you look at the total amount of stable coins in the last cycle, which let's say we're in the depths of the bear right now. Basically, stablecoin volume went down like 40%. Well, stablecoin TVL on chain is staying flat. And so, if anything, the comparison with last cycle is this is like a fundamentally better situation to be in. And as we assume a more bullish perspective, things will continue to take off. But the third category, which I think is most likely, is that it's going to be some macro narrative around BTC and probably ETH that really drive everything, up. And then price begets narrative, begets price, and that takes over. And so, what we've been trying to see is what are the green shoots that we can point to on the macro side of crypto, and STRC honestly is the most green shoot thing that I have seen in the last probably month or two, basically from the start of the year, which is just like a really positive take, and something that, if we continue to see this type of activity and sales, um, I think could be something that drives a lot back into crypto pretty quick.
Yeah, I mean, remain bullish on Bitcoin, on ETH. I think there's enough dry powder there and enough buying action from the main DATs, followed by ETF flows, that any sustained recovery will be chased. I think a lot of people are short too. Like you saw that with a lot of these DATs, which are now like kind of buying puts, selling calls, trying to monetize. But if they're not tracking their underlying asset, they do have to buy that back. So I would assume a lot of them are kind of hedged right now on this conflict. But if it were to resolve, and who knows if that's likely to happen, that will be good. I think the other kind of macro stuff that I think about is, I think a marginal cooling off without totally blowing up the AI trade is good. Like, it's just been such easy money for so long to just like buy the data centers, or do like a triple layered SPV, that if it gets a little shaky, I think that's actually positive. And then I think the last thing on the macro side is just lower interest rates, and Trump actually, while we've been speaking, called for an emergency cut. Get to the levers and start doing whatever. I don't think they're gonna cut maybe at all this year. It kinda depends. Like, I do think, home buying rates go down just because 'cause they're buying a lot of MBS, but the Fed funds rate, like, kinda who knows? What else do we got here?
Should we talk data centers? Because you just mentioned it.
Yeah, I mean, data centers is something that candidly we own a significant amount of. And a lot of these we initially were introduced to through the bankruptcies of some of these assets. Notably Core Scientific. Iron never went bankrupt, but they were an old Bitcoin miner as well. And they were just kind of Johnny on the spot, ready with power shelled, hooked up, ready to go with GPUs. And these things, it's been incredible to watch how they've turned around. They've kind of sold off over the past 6 months as the AI trade is cooled in the public markets. But they're using Bitcoin to finance, buying these GPUs. They're then swapping out the Bitcoin miners for the GPUs and renting these out. It's all very fascinating. I think there's a really strong bull case here. The thing that I get nervous about is just like, can you run these models on a phone? Does edge compute meaningfully disintermediate these data centers? Um, And then there's like the science angle of like, what if they invented a new X and then, we don't need all the like kind of like the fiber argument. Maybe not quite as apt, but yeah, that's kind of my take. I still am very bullish on these things, knowing that we will need 1,000x more compute to get to AGI. Just the financing of them is really tough. And I think that's actually where crypto and USDAI is playing a role. And apparently, people at these large companies, including NVIDIA, have heard of USDAI and they're very bullish on it. They're looking for more large checks that can be written, and stablecoins are one of the logical, I guess, like 13-figure pools of capital that you can tap.
Maybe to go back a little bit, one of the reasons why Bitcoin miners, have such an advantageous position is because they're already approved for electrical hookup to the utilities. And the thing that is becoming clear, and Satya talks about this, basically everyone at Google, Microsoft, Amazon, the hyperscalers, but also now some of the neo clouds, is that if you don't have grid connected power, you're not able to get it in the next probably 5 years. And so if you think about it, it's basically there's a couple of components. There's like energy, there's land, and then there's the GPUs, or kind of the equipment itself. Um, the land, I think, is relatively pretty cheap, so long as you have access to the things that you would need. The energy is just hard. It's not super expensive. It's about like somewhere between 5 and 10% of the operating expenses of the data center is energy. But if you don't have it, you can't turn it on. And so it's this like not that expensive once you have it, but if you don't have it, then you're in line, and it's 5 years to get hooked up to most of the utilities. And so what people like Elon and XAI are doing, or even Amazon and Microsoft now, are partnering with off grid or behind the meter type energy sources, whether this is gas turbine. Also, to get a new gas turbine, it's a multi-year wait. In the case of XAI, he put the what is it, the macro hard, whatever that
The roof.
whatever he's calling it, the data center that has like a gigawatt of power, he put that right next to a defunct natural gas refinery or turbine, or energy power plant, has restarted it and using that to power it. You've got Amazon partnered to buy half of the power from a nuclear power plant in the Pennsylvania Susquehanna region. I don't think that that's turned on yet, but that's how they're moving, and that's the direction they're moving. And then Microsoft last year announced that they're restarting 3 Mile Island nuclear power plant and paying $20 billion to do so, so that they can have that be their power source. So power is just exceedingly important. And people talk about having solar. Solar doesn't have the baseload effects. You only get about 5 hours of solar per day, even in the most sunny environments, just based on the way that it absorbs energy. And so you basically have to have power. The only things that already had power are the Bitcoin miners, because they've been plugged in for the last few years and they've been upgrading their services. It's now just this relative trade off of how much can you get per megawatt, how much revenue can you get per megawatt if you're doing Bitcoin mining. Right now, it's the mining economics are terrible with Bitcoin at 70K, but you can start to move towards other, more high profile, recurring AI data center type opportunities. And then to your point, how do you finance the GPU purchases, or even the rebuilding of the shells to be able to house these GPUs is kind of the big question that a lot of these, Bitcoin miners are going through. And so the bet is basically that you think that we need more GPUs, more gigawatts of compute. And if you look at any of these, Oracle forecasts, Microsoft forecasts, we need to like triple the amount of AI data center compute capacity over the next couple of years. The only way to do that is to power basically every single powered megawatt with AI GPU compute. We're also starting to see more inference demand take off, which doesn't require this liquid cooled, um, you know, GB300 Vera Rubin type, operation to do pre-training or post-training. But you can start to have some of the air cooled GPUs process the inference. And so it is, I'd say, one of the most fascinating places right now, just in the value stack, in terms of you don't need to take any bets on these products or categories as an investor into any of these categories taking off. You don't have to put in, $100 million into the $10 billion round or the $9 billion round for Replit and hope that they can pull off, some miracle. You can buy these that are further up the value stack that are going to be applicable to basically everything. And a lot of these trade in public markets. But I think the question is, and yes, there are kind of like tail risk questions. Like, are we going to create a model that doesn't require as much compute? That's what DeepSeek was basically like a year or so ago. It's like, oh, we don't actually need that much. Okay, it calls into question the entire thesis. Are we going to have edge compute, and is it going to be like Microsoft or Mac Minis who are going to be doing most of the inference demand? And I think that that completely remains to be seen as well. Or is it going to be something that over the next 5 years is one of the most successful categories within AI and TBD on the rest of it. And so I think kind of the question that we think about, or that I at least think about, is where is this going to play in the general AI narrative? Right now, it seems like there's just a lot of, once again, risk off. People are like, okay, I'm going to wait to see more information. Some of these things I think are going to be building out over the course of 2026. Let's wait and see. But I would say broadly, like this is probably going to be the biggest category, at least in the public markets for AI, until these foundational model companies go public. And it's an attractive place to be.
And if you're a private company, there's no information needed. It's just great. It's
Yeah.
Everyone's feeling very good, and I actually got hit up yesterday with an SPV for, um, I'm not gonna say which deal, but it's one of the ones that just got announced. Just a flat 3% management fee and then 15% carry. That's it.
Not even, I've seen 10% upfront fees and then 10% carry.
It feels like what's happening with, like, it feels like this is the first real cycle where everyone has discovered secondaries in Silicon Valley at this scale. And it kind of reminds me of like when NFTs were trading, because like the illiquidity becomes a feature of the NFT. It's like it's worth what someone will pay for it. And like if you can get a bunch of people to buy an Ether Rock at $5 million per, well, it's like that's an amazing asset at that market cap. It it's going to be interesting, and the funds that are being raised are so massive. Like Spark, which is not historically like this large of a firm. Like I think they're raising 3 billion. Like everyone is Tiger Global size from last cycle, and the startups are all like 10 billion this time, maybe five to 10. Um, and I think where our heads go is like maybe we should just wait for these things to IPO and like buy them when they're 50%, 70% off. If that happens, maybe we might not be that lucky, but um, I do think to wrap it all up because we got to hit it in a minute here. Um, Seems like Sailor's discovered something. I would expect Tom Lee to follow suit. The rest of the DATs seem to be a shit show completely. Hype and Sky are looking good here. And then Venture is slow,
There
but
there's other ones that are looking good. I would say
Syrup's looking good. Drive is looking good. Uh,
there's revenue metas that I think are gonna start taking off.
yeah. And within that sector, things are looking pretty good. Venture's slow. And then we're kind of both just baffled by the feeding frenzy that's going on.
Yeah, it makes, to yeah, my concluding thoughts are, I think we're so far down on crypto that we're gonna start to see bottom,
Yeah.
um, and things will come back very rapidly if we start to see kind of these green shoots become real potential staying, with real potential staying power. But the things that in our thesis is basically that the things that are gonna come back that are not BTC, ETH, or Sol, are the things that have a really strong business, a really strong revenue meta. And you can look at that as hype, pump. You can look at that as sky. You can look at that as basically all the assets on chain that are producing revenue in excess of their costs and buying back their token. Those are gonna be the things that outperform. And the recognition of that and building more attention towards it will be, um, frankly, something that moves very, very rapidly. But I think we'll start with a macro move where people are offsides on Bitcoin. Maybe it's Strive who just accumulates like tens of thousands of BTC over the next couple of months. And then people are like, wait a second, this is huge. This is persistent. This is now a new feature within the ecosystem. Um, or maybe it's something like we didn't even talk about it, but like the BlackRock staking ETH ETF launched today. And that is, I think,
Yeah.
uh,
That's a good start too.
yeah, according to James Seifert, it seems to be off to a decent start. And we'll see what happens. But there's going to be all these types of products that just kind of become new, absorptions of assets, that I think will become really, really attractive. And then the rest will follow. And so I think we're kind of at that stage where not many people are paying attention to crypto because there's too many shiny objects elsewhere and like multi-billion-dollar valuations everywhere. Um, and yeah, it is something like a ceasefire or an ending of the conflict. I think we'll have a lot of people off sides, and that could be the basically catalyst to pull everything back out. That would be my guess as to where things move over the next couple of weeks or months.
I mean, we're about to close here, but ETH is green on the day. And like I sort the way I look at stocks, it's like I sort worst to best and like it's everything is red today. Um so if you want something low risk, go get some T bills. But um I think some of this is starting to look attractive here. And crypto always front runs. Remember that. It's always fun to make fun of crypto while it's crashing, and then it's always not as fun when the other industries follow suit. But I think we're looking good here. So we'll call it there. Thank you, everybody. See you
We'll
maybe
see you
next
next week.
week. We do this next. Peace.